us now. Ashwini, good morning. Thank you for joining us. We are in a spot of bother, Ashwini. I mean, a compulsive bull like you and me would always try to call that as a minor adjustment. But looking at what's happening to crude, how metal prices have gone higher, and how bond yields have sold off in US, are we in a spot of bother now?
Nikunj, I don't think so. I think, we may see a correction in the broad market simply because we've had such a strong run without any meaningful correction all the way from May 2020 all through till now. So it's possible that the correction continues purely because, it needs a breather. But I'm not worried that the rising oil price or rising metal price can play a significant spoilsport to the earnings forecast that we see going ahead. First of all, just to put it in perspective, oil is pretty much at the same level as it was pre-COVID. So it did go down during the COVID times and it's come back to nearly the same level. In material prices also, while I think there is some amount of dislocation in the short run, which is getting priced in by metal prices, as economies come back to normal in a post-COVID world and production restarts, we expect some softening in material prices going ahead. So I don't see this necessarily as a spot of bother. Coming to bond yields in the US, you're right. The bond yields have risen quite significantly over the last 6 months. They bottomed out in July 2020 and are now trading at 1.35, 1.38, somewhere there, just under a shade of 140. Now, the crucial thing to remember is that prior to COVID, the long bond yields in the US were around 2%. So we are still very far from there. There is no chatter at the end of the Fed to taper its program. So I don't think that the increases in bond yields are going to be runaway increases. But yes, can they go up to pre-COVID levels as inflationary expectations take root in the US? It's possible. Does it mean that it will be as disruptive for the markets as it was in 2013? I don't think so, because you're really going back to where you were pre-COVID.
Ashwini, while we've seen a remarkable comeback in consumption, whether it is autos or whether it is white goods or whether it is economy-related sectors, at what point in time markets would say, look, high risk of inflation, high metal prices could hurt us? The reason why I'm asking you this is because if I look at the numbers which came from auto companies for the quarter gone by, or even for that matter any consumer durable company, they are facing the heat of raw materials. So either they will take a hit or they will pass on the price hike, which eventually will have impact on demand. Are you worried about that end of the economy?
Nikunj, it's my experience that the future expectations of growth, future expectations of what's going on in the economy determine the patterns in consumption and determine aggregate demand much more than interest rates in the Indian context or even inflation. To the contrary, I would say that inflation, if it is moderate, is actually positive for both corporate earnings as well as consumer demand. Because at the end of the day, some amount of inflation is what gives you the pricing power and the ability to offset the cost of borrowing. So I'm at this point not worried. I think what would worry me is if the government execution falls short on the big promises that the government has made via the budget. I think that to me is the real thing that we need to watch because the government has laid out a very, very ambitious program. And if it is able to deliver on it, then I think for the next 3 to 5 years, you could see a growth trajectory, which is very different from what we've seen in the last 10 years. And in that environment, even if we have a little bit of inflation, even if we have, some compression of margins in the short run till companies adjust their product prices, I think the market will take it in its stride. So I think the key driver to the market going ahead is going to be very different. I'm not so worried about input costs as things stand right now.
Okay, Ashwini, so let's assume that government is able to deliver 75 to 80% of what they've indicated. What happens to the market and to the economy next then?
Nikunj, if you roll the clock back 6 months ago, none of us could have expected that earnings for fiscal 21 and fiscal 22 will look the way they are looking. Correct? I think even now there is a significant amount of cautiousness when it comes to the health of the financial sector. If the government is actually able to deliver on 75 to 80% of its program, like you say, there is going to be a renewed confidence in the health of the Indian economy, the health of the financial system. And that to me is going to be a huge positive. Investments are going to restart in a big way. If the government delivers on its programs, you will see new assets go into the ground. You will see foreign investors put new money into India in long-term projects. I think this PLI is a game changer. So I think there are a lot of things happening. And I think in the short run, it's very difficult to determine how much the market will overreact to these, signs of positivity or underreact. That I don't know. But I think suffice to say, if the government delivers 75 to 80% of its program, like you say, then I think the earnings for fiscal 23 or fiscal 24 will turn out to be a lot stronger than what is currently implied in the stock prices. And that to me is the real deal again.
Okay, so, recently, we've been looking at, where perhaps to put money in the market in this setup, Ashwini, and really how one would balance out that portfolio. According to you, I mean, what would it be in terms of, has there already been a substantial shift towards cyclicals? Is it still in the works? Where would you say we're at in terms of really creating that ideal portfolio mix, given that we're in the midst of this recovery right now?
Aisha, great question. In the middle of last year, when we were looking at a fairly sort of uncertain environment, we had moved our portfolio, for example, significantly towards exports, towards market leadership, towards not having debt, and a lot of other defensive characteristics. I mean, and that played out quite well through to the end of calendar 2020. Sometime in the last quarter of the last calendar, we started moving significantly into financials. And I would say that financials continue to remain fairly attractively valued, especially if you consider that if the economy actually grows faster than what is anticipated and the government is able to deliver on, a large part of its design, then you will probably see much lower NPLs in the financial system than what the street is fearing. So my sense is that financials has to be a significant beneficiary of what's going on. And I don't think the recovery in stock prices entirely prices this recovery in. Coming to cyclicals like materials, we tend to be a little more circumspect about it because there are a lot of global drivers for materials, including what's going on in China, what's happening to production elsewhere in the world, and so on. And I, personally have learned that I am in no position to predict where material prices go. So I'm not a huge, supporter of that theme simply because I don't understand it. I'm not saying it's good or bad. But I think coming to other domestic cyclicals, whether it's industrials or whether it's construction activity, I think both will see a pickup. Real estate should also do well. So I think, the shift to the domestic economy is not over yet, at least in investors' portfolio. That would be my take. Because when I look at a lot of stocks, I still find them quite attractively valued, quite cheap, considering a more optimistic outlook in the last 2 or 3 months.
Okay, fantastic. You've also been favorably disposed in the past, of course, to the IT majors, but now do you see a little bit of a shift? As you said, there are slightly more inexpensive and more opportunistic spots in the markets currently, where perhaps one could start to buy a little more or put in more time and effort into finding those spots vis-a-vis some of the leaders that have already run up to this extent?
One very interesting observation is that, if we roll back to the global financial crisis in 2008, 2009, Immediately post the global financial crisis, all the IT stocks rallied, and they rallied really hard. And after that, there were some winners and some losers. Today, if you look at it, something similar has happened. All the IT stocks have come back because these are actually fairly defensive stream of earnings. But going forward, I think there is going to be a differentiation because valuations are no longer very cheap. So now you have to bet on companies that will deliver earnings which are much better than what is already implied into the stock prices. If you look at PE ratios on a historical basis, which is what I tend to do quite often, you will find that most IT companies, IT services companies, are trading well above one standard deviation away from a long-term median, which indicates to me that even if you assume a very strong recovery in earnings over the next 2 years, the stocks are reasonably valued. So from here, you will need an excellent execution or a much better than expected, delivery from an IT services stock for the stock to be able to outperform. So that is a challenge. I mean, we continue to own some IT services name and we really like them. And the debate in our head also is that, do we sort of use some of that as source for new ideas, more poised towards the domestic economy, or do we continue to run with them? Because the earnings trajectory is looking quite robust as things stand. So, we have shifted some. We've not shifted entirely, but valuations are looking toppy. So earnings surprise is going to be the key for individual stocks that deliver in the IT services space.
Ashwini, there's no doubt that we are in a high inflationary scenario right now, be it crude prices, be it metal prices, and they are going to eventually eat up into margins of companies. That said, the big rationale or the tactical theme in the market is that you got to keep invested in equities till the time the interest rate trajectory is low. Having said that, if at all, maybe now, maybe 1 year down the line, we do see a trend reversal in interest rates. Do you think that this year could be an aberration, or this year could be, what we saw back in 2003, 2007, that equities continue to rise irrespective of rising interest rates? Could this year really be that aberration?
Aisha, great question. But let me try and parse between nominal inflation and real interest rates. Okay, so what you are really worried about is inflation driving up rates and inflation eating into corporate earnings. So let's take the two separately. Inflation driving up interest rates, I don't think is going to happen in the current year. RBI has been very, very vocal about it. And we are hearing similar noises from central bankers all over the world. So I think everybody wants to put COVID-19 clearly in the rearview mirror before anybody takes any step towards raising rates. If you look at real rates, on the other hand, real rates are now in the region of, say, about 1%, give or take. Right. And if you plot real rates over the last 15, 20 years, this is probably the lowest that we have seen on the real interest rate side for quite a while, barring maybe a small period towards the early part of, the previous bull cycle. And to me, the real interest rate is the real thing to monitor, because low real interest rates encourage investment activity, encourage people to borrow and to put new assets into the ground. High real interest rates discourage that activity. So that is a very big positive in my view. Second, you spoke about inflation eating into corporate margins. Again, what I would reiterate is that, is this just a back to normal trade? Crude at the end of the day is back to pre-COVID levels. It is not at $100 or $120 where it got to post-GFC, which was seriously debilitating for inflation. At 60, 62, I mean, it's manageable. And moderate inflation actually is positive for corporate earnings, not negative for corporate earnings. And it is something that the consumer can absorb. See, it's only when inflation gets to 9-10% that it starts to become a serious problem, where inflationary expectations start to get entrenched and wages tend to go out of sync and companies are not able to pass the cost increases on. The 5-6% inflation on the consumer side and say 2 or 3% on the wholesale side is, I think, actually quite positive for corporate earnings in the medium term. I mean, quarter to quarter, you might see some aberrations because, there is always a lag effect cost increases versus price increases. So, you might see a little bit of, a wobble in some corporate earnings for the March quarter, for example. But I think in the medium term, a moderate inflation is positive for corporate earnings, not negative.
Okay, so if the big worry as an investor should be whether or not high commodity prices would eat up into margins or not, would you tactically try and at least reduce exposure or maybe avoid the staples for now?
Well, I said the staples is something that we've more or less been out of for a long period of time, because as value investors, they never really appeal to us. I really I have been out of them for a long time, and we paid a heavy price for that stance of value investing. So I can't say anything beyond that.
Ashwini, later this year, a lot of exciting internet or the new age companies will go public. It could be Zomato, Policy Bazaar, it could be Delivery, few more. How excited are you about that end of the market opening up? Because the ones which have gone public lately, Apple, Root Mobile, I mean, their shareholders have managed to hit out of the park.
So, a very interesting question, Nikunj. Obviously, India has very few new age listings, and the scarcity premium and what's going on NASDAQ obviously prompted investors to pile into the few names that were available. And these stocks, have done exceedingly well. I mean, valuations, can be what they are, but it's the scarcity premium that's driven up the stock prices. And obviously, I'm not taking away from the fact that these new economy plays have a long runway to growth ahead of them. And therefore, some of these companies could get a much bigger in size over the next 5 years or 7 years. So I am very excited that we will have new listings to look at and to choose from. And despite a value bias, I'd be lying if I said that we will not invest in any of them, for the simple reason that value can be sought even in highly priced or high P numbers, so to speak, if there's a long runway to growth. So I am very excited about them, and I think the street will also, be quite excited about these things, these names. I think the only risk is that, if the US markets were to take a tumble, for reasons I can't predict, then some of that rub-off effect that we've seen might be missing. But these are great businesses. They've been invested into quite heavily. They have a great future ahead of them. So selectively, yeah, I mean, I'm quite excited and hoping to invest in some of them as things go along.
There's one pocket, Ashwini, which puzzles me, which is if I look at valuations of DMart, what Tata's paid to buy Big Basket, how Trent has moved as a stock, what is happening to VMart. Now, this is one sector where growth is imminent, but this is one sector where valuations and disruption is the highest. And when you have Reliance, Tata's, DMart, all of them trying to compete and valuation so rich, I wonder what are markets telling you?
Nikunj, I think the secret to that lies in the very large unorganized space that is going to yield ground to the formal space. That is an inevitable trend. So, we all talk about this K-shaped recovery, and what you're seeing in the listed space is the fact that the large listed organized players are gaining ground over the small unorganized ones. And nowhere is the opportunity bigger than in retail. And that is what the street is trying to tell us. So intuitively, valuations look expensive, but there is so much ground for growth, and there is so much room to take market share away from small unorganized players that, you and I may be wrong in calling them too expensive. I mean, for whatever it's worth, the runway to growth is so long and so big that there can be multiple players that can survive side by side or even prosper side by side. So I think we'll have to see how this plays out. Some of this unorganized to organized shift might happen via online. Some of this might happen via offline. Most of the retail chains that you mentioned are creating a very formidable online presence as well. So it's not very clear whether they will lose the entire online business to a third party or an aggregator. Some of it will come to them as well. So I think we're in a very interesting space here. So I wouldn't write it off right now.
Great. Ashwini, wonderful chatting with you this morning. Thanks so much for joining us
Thank you, Aisha.
on
Thank you,
ET
Anu.
Now.